For the stock market, it's down. For bond prices, it's down. For the Fed to raise rates, it's still up. That's the bottom line. We're in August and we've had this massive bounce in all risk assets. So I look at this as this is the beginning of something that's really bad. And then I ask myself, why is it bad? Well, the bottom line, number one lesson in markets is liquidity. The M2 is running, money supply is still negative, most ever, 3%. The Fed is still tightening rates. China is playing out like an Ayn Rand Atlas shrugged. It's one person trying to manage economy that's way overdue for collapse. Most of the trading in the world really for cryptos comes from Asia. And I look at this as Bitcoin's the best leading indicator.
Bitcoin and other major cryptocurrencies, including Ether and XRP, suffered a sudden price crash this week following a stark crypto warning. The Bitcoin price had rocketed into 2023 but has seen its rally stall as traders fret the Federal Reserve could be about to stage the greatest rug pull ever. Now, after the U.S. Securities and Exchange Commission, SEC, delayed its decision on a closely watched spot Bitcoin exchange-traded fund, ETF, application by Cathie Wood's ARK Invest, the Bitcoin and crypto market is braced for a flurry of SEC spot Bitcoin ETF decisions, led by the world's largest asset manager, BlackRock. The total cryptocurrency market has declined about 6.6%, more than either the Nasdaq or S&P 500, which are down 2.5% and 1.6% respectively. Approximately $60 billion has evaporated from the total cryptocurrency market cap, according to CoinMarketCap. The sudden floor falling out of the crypto market follows an unusual period of stability, as Bitcoin traded near $30,000 for more than a month after rallying in the wake of a flurry of applications for Bitcoin spot ETF, most notably from BlackRock in June. Mike McGlone shares his views on the Bitcoin crash, pointing out that it wouldn't be surprising if the risk asset went down to its starting levels and in fact may be the case if the macroeconomic system remains the way it is at the moment. He gives various reasons why he thinks this would be the case, as we are going to see in the video below. As you watch, don't forget to hit the like button, subscribe, and drop your comments. Let's now get into the video.
Now markets go to the point where they can create the most pain. That's bottom line. Getting into how you fix the transmission on the car is something I learned to deliberately ignore in the trading pits in the 80s. And that's why I wish the best for traders. Most of them lose money. A lesson I learned from Jim Rogers. A lot of you know who he is. If you don't, Google him. I met him probably 15 years ago, at least 10 years ago, in Singapore at his home. Was the best positions he's ever had are the ones he got involved in, never looked at, just don't even, I don't want to see the statement, don't look at the trade. That's the way I see Bitcoin. You're not supposed to trade this, although it's the best trading vehicle in the world. Let those absolute complete professionals trade it. And that's the thing I learned in the trading pits. Those guys who traded analog back then were a bunch of slobs, but they got in the pit, they'd rip your head, they're a bunch of sharks. Now it's just so automated and bots and everything. I just say, thank you. No, I say, don't mess with it, but you hit stops. The path of least resistance right now for Bitcoin is down. For the stock market, it's down. For bond prices, it's down. For the Fed to raise rates, it's still up. That's the bottom line. We're in August and we've had this massive bounce in all risk assets. So I look at this as this is the beginning of something that's really bad. And then I ask myself, why is it bad? Well, the bottom line, number one lesson in markets is liquidity. The M2 is running, money supply is still negative, most ever, 3%. The Fed is still tightening rates. China is playing out like an Ayn Rand Atlas shrugged. It's one person trying to manage economy that's way overdue for collapse. Most of the trading in the world really for cryptos comes from Asia. And I look at this as Bitcoin's the best leading indicator. So I'll end with this. Let's look at just simple numbers. And the goal is not to get people upset, but I need to point out facts of where we are. Right before we had this massive pump in liquidity, M2 money supply, which went up 40% from the end of 2019 to the peak in 2022. If you look at every risk asset, stock market's basically unchanged versus that. Gold's basically unchanged versus that. Commodities are basically unchanged versus that. And Bitcoin's up about 200% versus that money supply. So I look at this as it's very likely we're just going to gravitate towards those means that we were trading at right before this big pump. In Bitcoin, that was below 10,000. I just pointed out facts. In the S&P 500, it was below 3,000. It's around 3,000. And crude oil is 57. So that to me that's the current trajectory, going back to those levels. And the bottom line is the Fed's still tight. So if you want to focus on macro, I'd say forget about trading. Let the people, those other, all these things I really deliberately click off when I click on cryptos when they talk about trading. The market's going to go up because it went up. be careful with those mantras. Those days are over. We've just had the biggest zero interest rate policy rally in our lifetimes, and it's all changed except for in one country. China's cutting rate. So I look at this as that asset that led the way. I published about this morning that Bitcoin to me looks like the stock market did in 1930. It is heading lower on a 100-week moving average. The Fed's still hiking rates. The big difference with the stock market in 1930 is the Fed was cutting rates and trying to help save things.
Yeah.
I have to point out the biggest important difference where Mike and I disagree is on all of his analysis on stocks. I tend to agree. There's this thing that we don't like to talk about as traders, but we call them fundamentals. And and fundamentals are exactly the opposite for Bitcoin versus the stock market. That's just fact. If you look at the hash rate of Bitcoin, if you look at the network, you look at the use cases, whether it's from Argentina to Venezuela to Turkey, etc., the amount of people who have currencies that are depreciating and paying globally are higher. If you look at the holders who are in Bitcoin, yeah, there's a core. I don't know what percentage of the 75% that haven't been willing to sell any of it.
While the reasons for Bitcoin's drop aren't immediately apparent, the larger macroeconomic outlook has looked queasy in the past week, especially given recent concerns over the spiraling of China's state-owned property developers. The sell-off is not, per initial reports, the result of hundreds of millions in Bitcoin sales from Elon Musk's SpaceX. Bitcoin holdings owned by speculators are nearly 90% in the red after the flash crash to $26,000, new research says. While only totaling around 10%, the drop in Bitcoin to USD seen toward the end of last week upended market sentiment. As Bitcoin price predictions focus on $25,000 and even lower, the dust is settling on a trading environment accustomed to months of sideways behavior. Mike McGlone continues with his outlook on Bitcoin and general market sentiment, and what he believes would be the case in the coming days. Let us now get back into the video.
Here's a key thing I want to point out is 2018, I think it was 19, when the New York Fed came down on Tether and Bitcoin and Tether wobbled. It was around 5,000. That's when I got bullish on Bitcoin, around 5,000. Again, it went to 69. Didn't get the top, but that was a pretty good signal. I'm looking for any kind of signal to flip this downtrend narrative, which is clearly intact. And fundamentals are great. That's why I think in the long term, buy, hold, and invest. But in the short term, the best performing asset in history can easily go back to 10,000. It's still the best performing asset in history, particularly if and that, of course, is key thing about all correlations go to one, but you can't, this stuff has never happened in our lifetimes. We have money supply running negative. Bitcoin, it's never happened in our lifetime, life of Bitcoin. The 100-week movement average is trending lower. The high in this move was at the 100-week movement. If it's heading lower, the Fed is still tight and the stock market's potentially rolling over. So to me, it's the macro, and Bitcoin's just that leading indicator. And what's Bitcoin usually do? It overshoots. And it's also such a baby. I mean, it's just been around for so long. So I agree with the macro. That's why I started out. We're supposed to the buy and hold investors, but the traders, I think, are smart enough to know is you're supposed to be selling rallies. And by the way, because Fed's against you, and most all risk assets. And if we get lucky enough that we don't have a normal recession, hey, I'll end with this. We had our a mortgage analyst on this morning, Eric Idleborg, pointing out, mortgage is heading to 8% and pointing out the affordability index in U.S. housing is the lowest since the 1980s. We've never had an affordability index this low without a severe recession. That's global. I mean, it's worse in China. So I'm going to point out the macro. And here's, I think, about how important Bitcoin's in the macro is when I fill out my taxes, I have to point out if I buy, hold, or sold any type of cryptos. I've never seen that in any other asset. Personal consumption expenditures, employment cost index are running around 4%. Fed funds target is 5.5%. It's very restrictive. A year from now, I fully expect we're going to be talking about severe deflation. If we're not, blame me. I mean, it's happening in PPI. It's happening. We've seen peaking in everything. The one key thing, the bottom line trigger is the stock market has to stay at these levels. It's just it's the measure of everything. And if you look back at history, if it starts rolling over, which I think it will, it's going to be severe deflation from taking money away from everybody. That's usually how it works. Now it's happening in China. Number two economy. It's happened in Japan. It's been happening since 1989. Now we just had this bounce or tilting that way. The bottom line is you look at Fed rate hike expectations. I look at it in the terminal every time I come in. It still shows for the November meeting, the 30%, they're going to raise another 25 basis points. To me, I look at this in the U.S. 2-year note, around 5% means you're guaranteed 10% in about the next 2 years, when I fully expect virtually all risk assets are going to just continue to, maybe be down 20%. To me, that's what I think the smart money is doing on a global basis. And then you also have talk about the dollar. The dollar is the most expensive to short major commodity on the planet. It's just hard to short it. And that's also another thing I got from our meeting this morning about, yes, we're going to see higher for longer in rates in Jackson Hole, but it's the issue in China is much worse for Europe than it is here. And I see nothing but the lessons I've learned about treasuries. Every time that people tell me since the 1980s that, oh, yields are going to go up because we're having more debt. Well, they do the opposite. Yields go down. That's been the case with Japan. And now it's still don't fight the Fed. I think the macro is just bad for everything at these levels. And hopefully we'll get out of this, particularly what's by its nature, recessions are deflationary. Now, maybe we'll get lucky this time, but the way the Fed's going right now. But I want to tilt over the one thing that I think is quite obvious from just an outsider observation that reminds me of what happened with Madoff, and that is Binance. When Binance came into the space, their volume jumped so far, so fast. My first thought, without any indication, was there's a lot of electronic trading going on. They're probably inspired by things I learned about in trading pits. When an exchange launches a new product that wants it to trade, they'll support locals to trade it. Now, I look at this, they might have done something on a very big scale to support the bots to just trade so we can get the volume and show how great we are. That's just logical. But the point is, when you see volume jump that much, that fast versus all the competitors, yeah, was it done organically? I'm sure there's a little bit of stimulus there. So that might come out. It's just like Madoff came out. And that stuff only comes out when the tide goes out.
U.S. Treasury yields fell on Friday as investors considered the economic outlook, especially regarding inflation, and assess what could be on the horizon for Federal Reserve monetary policy. At 4:14 p.m., the yield on the 10-year Treasury was down by more than 5 basis points at 4.253%. This comes after the 10-year yield reached levels last seen in October 2022 on Thursday. The 2-year Treasury yield was down by more than 2 basis points to 4.94%. Investors considered the state of the economy and assessed the outlook for Fed interest rate hikes after Wednesday's release of the minutes from the central bank's most recent meeting. The minutes pointed to the possibility of further rate hikes, with policymakers noting that inflation remains too high and further restrictive monetary policy may be needed to sufficiently ease pressures from higher prices. Any such policy moves would depend on the state of the economy, the minutes indicated. The Fed has hiked rates 11 times across its last 12 meetings, keeping rates unchanged only at its June 2023 meeting. There are 3 policy meetings left this year. Many investors were expecting the Fed's July meeting, at which the central bank raised rates by 25 basis points, to mark the end of the rate hiking cycle. Recent economic data has painted a somewhat mixed picture about the effect of the Fed's rate hikes so far, which aim to cool the economy and ease inflation. While data suggests that inflationary pressures are easing, other areas of the economy, including the labor market, have shown resilience. Fears about elevated rates dragging the U.S. economy into a recession have not come true so far. No key economic data is due Friday. What do you think of Mike McGlone's projection for Bitcoin? Let us know your thoughts in the comment section below. Also, make sure to leave a like, subscribe, and turn on notifications for future videos. Thanks for watching.